If things do crash, well, hopefully you've got all your gold stored properly in their capsules and tubes. I guess what I'm saying here is don't try this at home. I'm a professional and this is a closed course with carpet. So gold's big opponent these days is the US dollar. It's kind of a strange idea if you think about it too much, but if you don't think about it too much, well, it's kind of a nice idea. If the dollar is doing well, then the world's largest economy should be trucking right along. Shouldn't be any widespread need to sell off your gold holdings. And then if the opposite is the case and the dollar's weak, well, there's probably trouble in the mix. And that idea of gold as a hedge starts to kick in. Well, the reason that I say you can't think about this too much, of course, is that the dollar can be strong relative to other currencies without things being all sunshine and lollipops. We have proof of that. We've been seeing it happen. And gold price isn't just static, like I've seen people suggest, where the dollar ebbs and flows, but gold stays the same. It's just relative to the value of the dollar. That isn't actually the case, but there is a direct link. So, what happens if things get really bad? What if the economy really does crash? What happens to gold then? If the dollar and the gold are so closely linked, a US economic crash would push the price of gold up, and everything would just hypothetically even out. Now, earlier this year in March, we got a scare for the US economy with big bank closures. It looked like they might be an early domino on the table. And if you look at the gold charts at the time, gold didn't miss a beat. Now, we were just starting to see a retracement at the time, but that news sent gold shooting up 9.5% in just a few days, and then it continued on to 2050, getting really close to a new all-time high. Now, this is the hedge idea where you want alternative asset classes to balance out unexpected calamity. So we need to take this a little bit further because March did not take all those dominoes out. We saw investors jumping into gold on the risk of collapse, but the collapse didn't actually happen. So we had huge inflows to gold, pushing the price up, but that spike wasn't really coming from a crashing economy. The dollar took a hit, but not enough to trigger that kind of response for pricing gold. So March might be a little bit of a false positive there, or more a case of sentiment than a case of actual cause and effect, because the cause was more about the fear of what could happen than any pain from what actually did happen. Now, if we want to look at an actual crash, we don't have to go back far. We can go back to March of 2020. The Dow crashed 26% in 4 days. I think that qualifies. And that's just one data point. Everything crashed, really. You had oil prices, treasury yields, stock markets, and gold. The spot price of gold, anyway. I always enjoy seeing people comment how they loaded up on those few days when we hit that crash. I mean, it's a great story, but dealers weren't dumb. I couldn't find a single shop, online or otherwise, selling at that flash crash price that week. Local shops weren't even open. And anyone remembering March 19th, 2020 as a fun buying opportunity is probably doing a really good job of fooling themselves. Now, gold came back fast, though, and that's the typical story. Just look at what happened in August. That was an all-time high. Now, gold, it's not immune to the effects of a wide-scale crash, but it recovers more quickly. And the idea there is that it has international demand. So if your local economy is crashing, well, the price is somewhat insulated. And that makes 2020 a really bad example here because that was a global crash. But gold is easy to sell wherever you're at. And that tends to be why we see that initial drop in price, because traders have to sell whatever assets they can sell to cover other losses. If we were to look back through the charts, we see gold outperform the S&P during and after recessions. And there's historical precedent for it most of the time. Of the 8 past recessions, gold has outperformed the S&P 500 in 6. Why only 6? Well, there are other factors in play. In 1981, you had Paul Volcker raising the Fed funds rate above 15%, and in 1990, central banks were net sellers of gold. They had other stuff going on. Britain sold half their gold reserves. We're going to save that one for another time, and Volcker probably deserves his own video too. But I'm not real sure I'm the one to do it, because in 1981, I was using clothespins and cards in the spokes of my bicycle wheel to make it sound a little cooler. I wasn't spending that time on the phone with my broker. So we have a few ideas going here. One is that when the dollar is strong, it's a competing force to gold. Gold is a safe haven, particularly when the treasury yields are high like they are now. And then when the dollar is weak, well, gold's price in other currencies is lower. That increases demand. And then if the dollar is weak and the treasury yields are lower because interest rates are lower, well, then there are two factors pushing gold up. So those are simple price factors for gold. Now, the recession chart that I just showed gives some historic perspective for price in a recession. That's something that I find more relevant than immediate performance for gold price during a flash crash. So put all this together and it gives two reasons that gold could be going higher in the near future. One, it's going to be a possible recession. Another would be the Fed cutting the rates with an eventual reversal. So if we look ahead, the likelihood of an economic slowdown is high. The likelihood that the Fed will lower rates is more or less certain, and both of those scenarios push gold up. Before we happily ever after this, though, I think we need to look at one more thing. We need to look at what happened in 2013. Gold fell 28% in that year. It was a $1 trillion crash, the worst in 30 years. It lost 10% in one day alone. And if we look at the charts, you can see that it really didn't do much for about 6 years following. Now, it was around in 2013, and there were a number of factors contributing to that price drop. And I'll just say prior to that, it was a huge run up to get to that point to begin with. Can't forget that. But in 2013, the US dollar was rebounding, finally shaking off the impacts of the 2008 financial crisis. You had investors getting their confidence back. And then you had the Fed announcing the tapering of QE. And there were probably 100 other things. I wasn't spending my days souping up my BMX, but it's hard, at least for me, to fully explain 2013. We had global events happening as well. India had cut back on gold imports. That was a big one. So there was a lot going on. And as a general note, I just say that bad things can happen to the gold market when people decide that the economic outlook is looking up. And that's a hard one to show on a chart, but I think that it's just common sense. So there's some contradicting ideas there. A lot of different angles on gold performance. You have during a crash, immediately following a crash, and then post-recovery. And I would say that we're looking at a recession ahead of us. The important parts of a recession, if not the actual label. I think that we'll see the dollar pull back. I think that we'll see the Fed reverse the rates. And I think that we'll see the price of gold going up on both of those scenarios. And then somewhere along the way, we might see that feeling of recovery, and we might see the price of gold drop back down. Now, my basic plan is always to buy more gold when the price is going down and buy less when it's going up. And I think that that idea plays into the larger picture of crashes and recessions too. Can't always back up the truck in a 4-day flash crash like we saw in 2020, regardless of what people say. Shops aren't even open. Dealers haven't lowered the prices, but we can wait out the extreme spikes in price, and we can buy up the extended valleys. Now, I sat out 2011 and 2012. It felt like the prices had just gotten away, and then I bought consistently late 2013 through early 2020. And that wasn't out of any real planned strategy. It was just that I saw a price drop of 25%, and I was very happy to start buying at that point. So I think we've covered the basics here. We looked at some charts, we mentioned some historic trends, we talked about what should happen, but I think the smart play is always going to be proceed with caution. I think we're ahead of a price run. It feels like a pretty good time to be buying right now. But when the prices do shoot up, personally, I'm going to be a lot less excited to be buying. If the price gets too close to the sun, the wax holding the feathers melts off, Icarus falls to the ground and all that. There's some of that with gold for sure. Especially when the price moves don't always make sense. So planning around an economic crash or recession is pretty tough unless you're just going about it in general terms. Now, to me, general terms means having some gold. I think that that's a general term asset. I want to grab it when it's cool. I want to avoid it when it's too hot. But the idea is to have it before I need it. And I think that's probably a pretty good way to sum it up. Let's call it good there. Let us know if you're buying gold ahead of a crash. Is it that specific to you, or is it just a general balance? Maybe a practical asset, something shiny even. A bit of all the above. Let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you'd like to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.